These are market measures brought to you by the SIBO. And today we're calling this Understanding Put Skew and Trade Risk. Understanding put skew and trade risk. So what we're going to look at today is if the put skew is high, is there more risk or less risk?
Okay. Like, I mean, you without, I mean, I've seen some of this piece, so I don't want to answer it. So I'm going to ask you the question. I know you've seen it too, but what would have been your thinking prior to this? Would you have thought it would be random and not make any, make any difference? Would you have thought that, it was warranted? There is put skew because of the velocity. What would you have thought?
My feeling about markets are, I always used to think there was obviously less risk to the upside and more risk to the downside. I always felt like, the skew made sense to me because there was always, because of all the velocity to the downside. When markets get killed, they crash. When markets go up, they're pretty, they're pretty ordinary, pretty
orderly.
Yeah, they're pretty orderly. But in the last couple of years, and I'm a premium seller, and I always thought premium sellers get killed to the downside.
We've been
in the last couple of years. All of my losses, big losses outside expected move, every single one of them is to the upside. So, what?
I get you. Yeah. I'm sure it wasn't everyone, but
no, there was a move down in Netflix and a move down in Facebook.
There's always one or two, but the majority of them to the upside.
Yeah, we did have a down move in Netflix and a down move in Facebook that really caught us on both those down moves, and also a down move in Target. So there were like 3 down moves over the last couple of years. The Target dropped like 25%, Facebook dropped like 25%, and I want to say Netflix dropped like 33% all on earnings plays. On the upside, our absolute worst trades are upside moves. And I think the worst of them all was probably Zoom a couple of years ago that opened up like 200 points. And then also, of course, recently in NVIDIA, that wasn't good. But there's been a couple in there. I think the worst moves have been to the upside for me.
Okay, fair enough.
Okay, so let's take a look. Understanding put skew. So dividing the put price by the call price of the at the money options of the same delta gives us it's like an approximate ratio that tells us what the put skew is of an option. So because CVAR, which is a conditional value at risk, which is now available on Tasty, can vary depending on an option price, we can normalize your conditional value at risk by dividing it with the BPR to compare options of different prices, coming up with a metric that we are going to call trade risk. So what we're doing today is we're basically looking at the put skew and determining what the trade risk is with respect to put skew. And trade risk being defined as us being able to normalize CVAR by dividing it into buying power. So comparing the put skew and the trade risk allows us to see what the potential tail loss is of a trade. Okay, that's pretty interesting. Something we've never done before. We've never done this before. So it's kind of comparing put skew to trade risk to see what the potential, tail loss is. Let's go next slide. So for this slide, we use, 2, 4, 6, 8, 10, 12, 14, 15 different stocks. We compared the price of the strangle, 16 delta calls, 16 delta puts short, along, and the CVAR adjusted for buying power, so we can get what we call trade risk. Computed the ratio of the put price to the call price, the trade risk, which is CVAR divided by buying power, and then the slope of the trade risk and the put call ratio. There's a lot in here. Slope of the trade risk and the put call price ratio. All right, let's go next slide. Let's get into the nitty gritty here.
A lot of math for the bet right now.
Yes, this is what we do. We do a lot of math here at Tasty. So looking at looking at the slides, the first thing we noticed is that the numbers that certain stocks that have, like Nvidia, that have already, reported earnings and had these you know how, like we always like to say, after something has had this massive move, it has a tendency not to have kind of the same kind of move. And so that's why you can see Nvidia kind of at the lowest put call ratio and the lowest trade risk. And then the highest on the flip side, like Bristol Myers Q's, they haven't had the moves. KRE, McDonald's, just interesting. And then everything starts to drop off into a much narrower range once you get into the NASDAQ tech stocks. Mm-hmm. But the put call price ratio, which again, the argument here is just, this goes into very much into line with what we discussed the other day on air on one of our shows, is that when the risk is the greatest, when the skew is the highest, SKEW, and the risk is the greatest and volatility is the lowest, you have the most amount of risk. Mm-hmm. When you look at these stocks that have the most amount of risk here, like Bristol Myers, the Q's, SPYs, KRE, McDonald's, those are all the stocks that haven't had the move. When you look at the stocks with the least amount of risk right now, they're the ones that had the biggest moves. Sure. Nvidia, GLD, AMD, I don't know much about Sony, but Tesla, mm-hmm. Microsoft, those are stocks with the least amount of risk. It's crazy. This is all relative. Yes. Let's go next slide. So we decided to graph this out for you and make it, because this is something, like I said, it's very new. The first thing you see is that C-bar increased as the price of the puts increased relative to the calls. And, suggesting that the marketplace still puts a heavy premium or heavy value on the traditional model of pricing index puts higher than calls. And then this was an interesting takeaway. For every 25-cent increase in the ratio of the put price to the call price, the C-bar increased by 10% of all your buying power. So
more risk has occurred, right?
Yeah. So as the puts have more skew, there's more C-bar. And so what that basically means is when you have the most amount of downside risk is when the skew is the lowest and the put premium is the highest. When you have the least amount of risk, just speaking based on the study.
On a percentage basis of risk.
When you have the least amount of risk is when the skew, SKW, is super high like it is now, and put prices relative to call prices are super cheap. And right now the skew is almost 1-to-1. So they're crazy. Puts are crazy cheap relative to calls. Mm-hmm. So based on this particular study and the information here, it's the least amount of outlier risk right now. And if the puts were to get expensive, then it would be the most amount. Right now, it's the least.
Okie dokie. I would never have looked at it that way.
Yeah, no, me neither. It's kind of weird, but it makes sense when you look at it here and you see the prices. It makes sense. Yep. Let's go to the next slide. And this is another takeaway. 97% of the C-bar variation is explained by the put-call ratio. So the relationship between put and call price ratio and C-bar is strong, and it's a strong positive linear relationship. So basically, that's exactly what it means. It just means as puts get more expensive, C-bar goes up, and it's almost linear. And I would have guessed not, because I always thought that when put prices went up, you actually took away some of that downside risk. Didn't add to it.
Receiving more for the option.
Yeah. I would have been wrong on this. If this was a question on a test, I would have got it wrong.
So you would have got a 99. Not so bad.
Maybe 98. Let's go to the last slide. They're very interesting, by the way. These are very interesting takeaways. But now I should preface this by saying this is pretty damn heavy. So I wouldn't expect everyone to say, "Oh, this is a piece of cake. It's going to change my trading." None of that stuff. What it really just means is that there's probably less risk in the market right now than we think there is to the downside, and that's actually the way it's played out. And
it has played out that way for sure.
Yeah, and that's exactly how it's played out. Yeah. And when put skew is the highest and put price are the most expensive, there's probably the highest C-bar. Having the highest C-bar doesn't mean you're gonna lose money. It just means that's when the risk reward and opportunity is the greatest. So between the underlying with the lowest put call price ratio, NVIDIA, and the underlying with the highest put call price ratio, Bristol Myers, there was a 40% difference in CBOR. This makes sense as puts trade at higher volatility than calls because investors are offsetting some of their bullishness of the stock positions. So higher volatility in the market leads to more risk. Yes. Higher volatility, we should preface that. Higher volatility in the market leads to there's fewer outlier moves, but by definition, more risk when they do exist. And so you get the crashes, but you don't get a lot of stuff in between.
Understood. Good job out of you. Good job out of the team. We're going to take a quick 90-second break and come back. We're going to your phone calls. So I need you to participate. I need you to participate right now. 855-238-2789 or 855-BE-TASTY. As unfortunately, we have no Scott today. He had to go to a meeting yesterday, so he's spent. But we can take your phone calls for the next half hour or more. 855-238-2789.
He's in physical therapy today, and
for his crown. 855-238-2789 or 855-BE-TASTY. That's the phone number to call. You want to speak to Tom Stoddard? If you got a question, we'll do our best to answer it. Give us a buzz. I got 4 or 5 lines open. Be back in 90 seconds.